Hello, everybody, and welcome to another session of Option Wednesday. I am Prashanth Lalu, your host for the webinar, and I am associated with Kotak Securities for over 15 years. And I will be talking to you about futures and options. In this session, you will have an in-depth view of futures and the intricacies of options, and also the practical angle of it, where you will learn how to trade in these derivative instruments, and also how we at Kotak give our recommendations and what are the parameters that we see before we give out a call uh, on the derivative segment. So let's start the presentation. So the most important thing that you will have to remember before getting into a trade is what is your view of the market? Are you of the opinion that the market or the asset is going to go up, or is it going to go down, or is it just going to be within a range? This is the basic fundamental aspect that you have to know before placing a trade. And once you made this decision, then you can choose the instrument, whether it's the futures or the options, whether it's a call option or put option that you want to trade in. The second most important aspect is what is your risk profile. Now, some of them are willing to take high risk. Uh, some may be risk averse, which is why you have different instruments. Again, for the same reason, based on your risk profile, you can choose the instrument that you want to trade in. All of this is what you will know by the end of this session. In the previous topic, the basics of derivatives, you have known about all the derivative instruments, plus a brief about futures and options. So let's go ahead and see, have a brush of what a futures contract is. As you know, it is between two parties who agree to buy or sell a particular asset at a specified date in the future, and at a predetermined price, and the quantity is already agreed upon. So again, when you enter a futures contract, it depends on whether you are the buyer or are you the seller. Throughout this session, you will have different aspects of both being a buyer as well as a seller, and based on your view of the market and your risk profile, you will be taking the desired position on the market. So let's take an example of Reliance futures, which the expiry date, as you can see here, is June 30th, which is the last Thursday of this month. So is this the only contract, the futures contract that is available for anyone to trade in? Actually, we have three different contracts. That is the current month, the next month, that is July, and the far month, which is the August. So you have an option to trade in either of these contracts. And the important aspects being the lot size. Now in Reliance, the lot size is about 250, and again, if you're going long, you would probably pay a upfront margin for Reliance to buy a futures contract. Usually what happens is, why people trade in futures is, let's say you wanted to buy 250 shares of Reliance in the cash market. The ideal sum of money, which is the Reliance price, which is about 2,630 into 250, would put you back by about 6.5 lakhs. Whereas when you buy a futures contract, the margin amount you would be paying is just about 1.5 lakhs. So there's a huge difference in that, and that is the advantage of buying a futures. So let's see an example here where on the 20th of May, Reliance was trading at 2631, and let's say you bought a futures Reliance futures contract. So you placed an order at 2631 and it got executed, and you bought the June futures. Since the expiry date of May was pretty close, you chose to go with the June futures. So let's see what really happens here. Within a couple of days, Reliance actually goes down to 2542. So what happens as a buyer is that you're actually making a 89 rupee loss, which is the 89 points, because after making a high of 2631, the next level that it has tested in the lowest level is 2542, and there is what your loss is, which is about 22,250. So this is known as the M2M loss. Now, as I told you that the when you buy a futures contract, you have to pay a upfront margin of about 1.5 lakhs, right? So what happens is at all given point, the buyer and the seller has to maintain that margin on a daily basis. So that means the buyer who is losing 22,250 has to put in that margin amount back, basically like topping it up back to 1,45,000. And if you're a seller and if you're sold at 2631, you would have gained 22,250 rupees. So you see, when there is a loss by the buyer, the seller gains, and as you can see, when the seller loses, the buyer gains. So what happens after 26th of May? The stock continues to rise, and eventually on the 3rd of June, Reliance hits a high of 2809, and you gained about 178 points from 2631 to 2809, and that is a significant upside. And let's say you decide to square off your contract, you are in with 44,500 rupees in your pocket for your trade. Now this 44,500 is your profit, whereas the guy who sold at 2631 will be at a loss of 44,500. So what are the important aspects that you have to keep in mind? One is the lot size, what is the direction that you're trading in, the margin amount, and that you have to keep topping up the margin every time it goes below your level. And this is every day. And once your direction is right, that is pretty much 50% of your trade. Once you get the direction right, then the rest of it is mostly on risk management level. And what we at Kotak always advise is that whenever you take a position, you always have a stop loss. Please keep in mind that to keep a stop loss for every trade that you get into, so that your risk is limited and your loss is limited, and you always survive for another day. So this is pretty much about the futures. Now let's go into the option segment and see what are the fine prints in options. So when we spoke about futures, we had the lot size, the date to expiry, the price at which you are entering the contract. These are the main aspects of futures. Now in options, you have something known as the strike price, wherein it is predefined by the exchange. And what happens is the buyer or the seller gets into a contract at the strike price, whether you want to buy, or if it's a seller, he can get into a contract at the strike price only and not at any other price. So let's again, what is your view when you're getting into options? Are you looking at the market and saying that, or the asset, and saying that this is going to go up. If that is a view, then the best thing for you to do is buy a call option, wherein as the asset price goes up, the value of the call option also goes up. Now, when we speak about options, there's something known as the premium. Like how in futures you have the margin, here you don't have something known as the margin, you have something known as a premium, which is paid upfront by the buyer of the option. Now, who is the buyer paying this premium to? The buyer is paying this premium to the seller of the option. And for the seller, that is the maximum profit that he can gain out of the option. That means the premium he gains is the max profit on the trade. So let's look at how these aspects work on options. So if you have a bullish outlook, you are going to go and pretty much buy call option. And if your view on the market or the asset is negative, or you think that the asset value is going to go down, you are better off buying the put options. Now, when you buy a call option, let's say, for example, Nifty call option, the market is at, let's say, 15,700, and your view is that the market would probably go to 16,000 by the end of June. So what you would do is probably buy the 15,700 or 15,800 call option, and you pay a premium. The premium probably would be, let's say, the premium amount is usually about 2 or 3%. So, and not as high as the futures value, which is a big advantage when you buy an option. So let's say the value of the 15,800 call option is 100 rupees, and the lot size for Nifty is 50. So your premium amount you would be paying would be 5,000 rupees. Now that 5,000 rupees is the maximum loss also that you can have at this trade. That is because, like in futures, how you need to top up whenever the margin comes down, you don't have to do that here when you're a buyer. So the max loss that you will have is 5,000 rupees. So let's say by the end of June, the market reaches 16,000. So the value of the option, technically, you would start making money on the call option about 15,900. That is because the strike price that you have chosen is 15,800 plus the premium amount which you have paid is 100 rupees. So anything above 15,900 is what you're going to make. So let's say the market closes at 16,000 and the value of the option will be 200 rupees. Why? Because 16,000 minus 15,800 would give you 200 rupees. And basically your option value from 100 rupees would have doubled to 200. And that is the power of options. Now let's say you have bought the option. What happens to the guy who's selling the option to you? Now he sold the option to you at 100 rupees. So his maximum gain is 100. So he's already got that 100 rupees premium in his pocket. So what happens is now that once the option price moves beyond 15,900, he starts making a loss. So your gain of that 100 rupees is his loss of 100 rupees. So it balances things out. However, if you're an option writer, you will collect the premium, but you will have to pay an upfront margin, which is the same as the futures. Okay, that is because the risk taken by the seller of the option is always higher because his risk can be unlimited. For example, let's say the guy who's written the 15,800 option at 100 rupees holds on to it, and let's say Nifty goes to 17,000. So his loss is going to be considerably high, close to 1,100. That is why he's taking a bigger risk when writing an option, and which is why the premium he has to, the margin he has to pay is the same as the futures premium. And yes, just like in futures, if you're an option seller, you will have to top up the whenever the margin amount comes down. Okay, so that is the basics of if you're a buyer of an option and if you're a seller of an option. So the best thing for anyone who doesn't want to, doesn't have a risk appetite of writing an option, the best thing to do is, if your view is negative, then you may as well buy a put option, and you will be shelling out a 1 or 2 percentage of premium, and that is the max you can lose, right? So let's see how it differs from how options are different from futures. So if your view again is on the long side, or if you're bullish, then on the future aspect, you are going to buy the future. You're going to trade at the future price. You don't have to pay a premium. Margin amount is anything between 10 to 15% of the contract value, and the max loss is unlimited, because it's a you have to keep topping up the M2M on a daily basis. And but the advantage is also that the profit also can be unlimited in the futures contract. And the quantity is, of course, the minimum lot size, which is similar to whether you buy a futures or an option, whether you're a writer or if you're a buyer. Okay, so if your view is bullish, you saw what you can do with the futures. Now, if you're buying an option, you obviously buy a call option, and where the difference comes is that you just pay a premium, and the max loss in buying a call option is to the extent of the premium you paid. And the advantage, however, is that your profit can be unlimited. So as I gave you the same example, if Nifty moves from 15,800 to 17,000, your view, which was 16,000, would surpass, and you would have unlimited profits, so close to 1,100 rupees in profit into 50. However, let's say, what is the alternative if you don't want to buy a call option? You could probably sell a put option. Is selling a put option the same as buying a call? Let's see about that. Now, when you sell a put, what are you gaining? When you're a seller, you're going to gain the premium amount. Now, a seller of an option plays on 2 dynamics. One is the direction. Again, he thinks that the market either is going to go up, or he can even say that the market can be within this range or be stagnant. The third aspect that he's looking at is the time value of an option. Now, what happens in an option is, as the expiry date gets closer, the value of the option keeps deteriorating. So this is what the writer of the option is backing on. So his advantage is when the premium erodes and goes to zero. That's when he makes the whole premium as profit. Vis-a-vis, if you buy a call and the market does not move in your direction that you had thought, then if it's within a range, the value of the option would come down, even though the market has not gone down, and even if it is positive. And because the value of the option erodes as the time to expiry gets closer. So this is something that you have to keep in mind. As a buyer, time is never your friend, it's your enemy. But if you're a seller of an option, time is your best friend. And as you've probably heard, that it is usually the writers who usually make more money, or are more successful in trading options than the buyers. And this is the major reason as to how they make their money by collecting premiums and waiting for the premiums to erode, so that they can have the whole premium in their pocket. This is a good example to show what happens when your asset price goes up or down, and in one slide you can actually see, let's say the underlying spot price is the blue line is going up. If the underlying spot price goes up, the call premium goes up, and similarly the opposite reaction is that the put premium will come down, right? And similarly, when the asset price or the spot price goes down, the put premium gains and the call premium reduces. Each action has a opposite reaction, is what you can say in calls and puts. So when one goes up, the other goes down, and you have both options of either writing a call or writing a put and gaining a premium if the direction is right. Now, why do people actually write more options? Most people would, when you're writing options, would have a range, and they would calculate that this is the range that the asset price or the spot price or Nifty will be in for a specific period of time. And usually at the beginning of the month, the premiums are pretty high, and their view again comes into place that okay, the market or the spot price is going to be within this range, and so let me write the options and gain that premium. And once I have that, I just have to sit back and wait for the time to expire, so that the premiums of the call and put head to zero. So that is usually their strategy. And so we have an example here as to how Nifty fared on the 9th June expiry. And we are comparing it to what if you had bought a 16,500 call or a put. So on the trade, let's say the trade was taken on the 25th of May, and where Nifty was at 16,026, and you're buying a call option of 16,500. The premium that the call option was trading at was at 112, and the premium of the put option was trading at 550. So what happened after that? Uh, the Nifty rose between 25th May and up to the 30th of May, before taking a break and moving sideways. So what happened to Nifty? Nifty moved from 16,026 to 16,661. So, as you know, if you are a buyer of a call option, the value of your premium is going to increase as you go closer to the strike price, which is 16,500. So, what happened to the value of 112? It became 296, which is pretty much more than double of what you bought your call option at. Vis-a-vis, what happened to the put option? The put option, which you bought at about 595, uh, went straight to 156. So you see the erosion of value in the put option, and this is something that I was talking about. That if the market moves against your direction, you will have to the value of the option moves drastically, and this is what uh, a seller of the option will also look at. So if he had indeed written or sold of put option, then at 595 he would have made significant amount of money. In fact, more than what the the premium at that given point of time was so high that probably he would have made more money than the guy who's made in the call option. So this is the dynamics of options and how they move. When you are a buyer, please make sure that when you buy an option, keep two things in mind: that what is the direction, that constitutes close to 50% of your trade, and once you get that right, the rest is about risk management, as I told you. And but if you're a seller, you have to be much more careful. You would probably have to be in front of the market to witness the price movement, and contain your risk, so that if there are any drastic moments, you could probably get out of the trade. um, right. So I am going to give you another example where we gave a recommendation on Bank Nifty, and how we gave this recommendation. So we were trying to so basically, Bank Nifty was trading in a range of 1600 points between 33,200 and 34,850. um, Once this range broke out, we knew that it is going to shoot up significantly, and which is why on the 26th of May, we recommended to buy call option of 35,500 strike at 230 rupees. So why did we recommend the 35,500 call option? Because we thought, the possible upside for Bank Nifty was close to 36,400. So once we gave that trade, within the 30th of May, Bank Nifty shot up to 36,080. And as you see, you have more than close to tripled the value of the call option. So this is how, we at Kotak usually use different parameters to give a recommendation on options. And now let's say we have a neutral strategy. So neutral strategies, as I told you, we were had a view that we are going to, Nifty is going to be trade within a range, and the range we thought would be around 15,800, 15,900 and 16,500. This was when the Nifty was trading above 16,100. So what we did was, we gave a recommendation to sell both the 15,900 put option and 16,500 call option, and we thought this levels would not be breached. But unfortunately, after the RBI policy and stuff like that, the market tanked, as you all know, and unfortunately, we had to close this recommendation at a loss. So yes, even when you have a strategy and you've hedged and you have a view, you can still go wrong, which is why we would recommend you to always keep a stop loss and trade when you're trading options or any other financial asset. Right. So that was wrap on the futures and options. So what can go wrong? Usually external factors, unexpected news. Usually when there are physical monetary policy or any political events or election, then the market can move haywire, and so does the option. Volatility increase, yes. Usually, again, before an event or before a result, what happens is the volatility increases and the prices of the options increase dramatically. And once the event is over, it suddenly drops. So please bear in mind that volatility plays an important role in options. And trade adjustments by large institutions, usually this happens, on stock levels. And if you're trading options in stocks, and if there is a liquidity issue, that also can affect your profit margins, and because you wouldn't be able to square off, and that would be a problem. So that's the wrap for futures and options. I hope you got a grip about futures and options, and you can take a chance and be a buyer, or probably depending on your risk appetite and your understanding of the options, be a seller either. So all the best to you. And now we can have the Q&A session. So one of the questions is, what do you do before an event? As I told you, before an event, we wouldn't recommend to take a trade. At least not be from the risk management point of view, you shouldn't be a writer. So what you could do is probably based on your understanding of the event, and if it is a positive outcome or a negative outcome that you're looking forward to, it is best to either buy a call or buy a put, so that your risk is limited, and to the premium you have paid, and that would suffice the trade for the event. And if the event goes in your favor, you are bound to make you know money on your calls or your puts. And I mean, because usually what happens is there is a drastic movement during after the event is done, and it wouldn't be really favorable, and we wouldn't recommend you to write options at that given point of time. Someone has asked how to manage stop losses. So let's say you paid a premium of 100 rupees on an option. Ideally, if it's a trade where you're carrying it forward for a couple of days, 50% should be your ideal stop loss, uh, which is uh, which is half of the premium, and that should suffice your stop loss. Uh, and again, if you're writing options, let's say you written an option for 50 rupees, the maximum stop loss that you should keep is 100, which is double the price of the the premium you've gained. So this is something you have to keep in mind. Again, stop losses are important, so please keep them appropriately. So So someone has even asked how to choose strikes. That's a good question. In fact, let's say you're at the beginning of the month. One is you look at the premiums and say, "Oh wow, the premiums are really high at at for at the money calls, which is probably right now at 15,800, 15,700 would be your at the money call." So let's say you go a little out of the money to 16,000. Since you have time in your favor and you have a full month to go ahead, you could probably take a 16,000 call option. And again, depending on your view that the market is going to go up, that would be a good strategy. Um, and as you get closer to the expiry date, I would advise you to stick to at the money options, which is this the same strike price as where the closest to the which is closest to the current market price. Because since you don't know, because time is not in your favor, it is best to buy the at the money call options. So that is about choosing the strike prices. So in our next class, you would be thought about option chain and geeks. weeks about all the various parameters that the option has, where you might have just heard about delta, gamma, or vega and things like that, and which actually affect the option prices. So all of that will be in your next session. I hope you enjoyed the show, and thank you for joining us.